Welcome to the Deep Dive. We're here to help you cut through all that information noise. You know how it is, right? Data everywhere, but what's actually important? Well, that's what we do. Today, we're zooming in on the Q2 2025 earnings for BioCryst Pharmaceuticals, ticker BCRX. We'll break it all down for you.
Yeah, our goal here is to get past the headlines, really dig into what makes this company tick. We've looked at their official release, what the analysts are saying, the market data, everything. And we're using a structured approach, a framework, to sort of peel back the layers and give you the real story.
Exactly. It's not just about, reading numbers off a sheet. We're connecting the dots, linking the company's data with what the market was expecting to get that full picture. We want to understand the why behind the results. The context is everything. So we've broken this down into 5 key parts. Think of them as building blocks to understanding BioCryst's current position and future strategy.
Okay, sounds good. Let's dive right in. Let's unpack this with slide 1, the at-a-glance scorecard. So first impressions of Q2 2025 for BioCryst. I mean, wow. It looks like a landmark quarter. They didn't just meet expectations, they really blew past them, both on revenue and on profit. That's quite a statement. Let's get specific. Total revenues came in at $163.4 million. The analysts, they were looking for something closer to $149.8 million, so really comfortable beat there. And then earnings per share, EPS. On that adjusted non-GAAP basis, which, let's be real, is what Wall Street watches closely, they reported $0.15 diluted EPS. That's a huge beat compared to the consensus, which was hovering around just 0.01 cents per share. Even the official GAAP number, the stricter one, was $0.02 profit per share, which is, a massive turnaround from the loss they posted last year.
Yeah, and you saw that reflected immediately in the market, right? Pre-market trading right after the news broke, BCRX shares jumped 8.81%. That's not just a small bump, that's real investor enthusiasm. You could feel it. And the analyst reports, overwhelmingly positive. We saw phrases like crushing expectations, talk about record-breaking sales for ORLADEYO. Some were even calling it the best financial performance in the company's history. That kind of language really tells you something.
Definitely. Let's put some more hard numbers on that year-over-year change. It's pretty striking. Total revenue, $163.4 million this quarter versus $109.3 million in Q2 last year. That's almost 50% growth? Yeah, 49.5% year-over-year. Impressive. But the net income line, that's where it gets really dramatic. They went from losing $12.7 million last year to making a $5.1 million profit this quarter. And for you, the investor, that means diluted EPS swung from a 6-cent loss to a 2-cent profit. Big difference.
And that EPS swing makes it a good time to quickly clarify what EPS actually is, because you see basic and diluted. Basic EPS is pretty simple. Net income divided by the average number of shares actually out there. For BioCryst, that was about 209.5 million shares this quarter. But diluted EPS, that's management giving you the more conservative view, the what-if scenario. It takes net income and divides it by more shares and includes all the basic shares plus any potential shares from things like stock options, convertible debt, warrants. Basically, if everything that could become a share did become a share, what would earnings look like? That's why it's usually lower. For BioCryst, the diluted count was almost 220 million shares, over 10 million potential additions. So yeah, diluted EPS gives you that fuller picture of potential dilution down the road. It's crucial.
Right, crucial context. And let's dig into how they achieved that massive swing from loss to profit. Because it wasn't just the revenue growth, right? The bottom line improved way more dramatically than the top line. That just screams operating leverage. It's like, once your factory covers its fixed costs, each extra widget you sell is mostly profit. BioCryst seems to have hit that point. The revenue jumped $54.1 million year over year. Okay, great, but their operating expenses, they only went up by $33.0 million. That widening gap, that efficiency, is what caused their operating income to just explode up 239%, from $8.8 million to nearly $30 million. That's how you turn a loss into a solid profit. I mean, yeah, there was a bit of share dilution, about 6.5%, but profitability just surged so much more.
Exactly, and that takes us nicely into slide 2. The engine of profitability. Because building on that operating leverage point, if you look at the margins, you see a business getting fundamentally healthier as it scales. Take the operating margin. That's operating income divided by revenue, basically. How much profit from operations per dollar of sales. Q2 last year, it was 8.0%. Okay, this quarter, 18.2%. It more than doubled. That's not just incremental improvement, that's a step change. It signals they've crossed that break-even threshold and are now in a phase where growth really drops to the bottom line. It's a huge signal for long-term value.
And when we talk profit, we often see GAAP and non-GAAP numbers. Maybe a quick reminder on what those mean.
Sure. So GAAP, generally accepted accounting principles, that's the official rule book, mandated by the SEC here in the US. Standardized so you can compare companies fairly. Non-GAAP is Well, it's an alternative view management provides. They adjust the GAAP numbers, taking out items they feel aren't part of the core day-to-day business. For BioCryst, common exclusions are things like stock-based compensation expense, maybe some deal-related costs. Now, it's important to remember, stock-based comp, even if it's non-cash, it's a real cost to shareholders through dilution over time. So non-GAAP shows the core engine, maybe, but GAAP shows the total economic picture.
Right. And the difference between BioCryst GAAP and non-GAAP this quarter is pretty telling. It offers two sides of the coin. Their non-GAAP operating income was $57.0 million. Compare that to the GAAP $29.8 million. That non-GAAP number highlights the, frankly, immense underlying cash-generating power of ORLADEYO itself. The drug franchise is incredibly profitable, but the GAAP number gives you that necessary, more complete view of all the costs, including the economic impact of things like stock options diluting ownership. So how to use both? Look at non-GAAP to see that core operational strength. It's impressive, but always check it against GAAP to understand the full costs, including those non-cash items that still impact shareholder value. It brings up a key question for you, the listener. When you evaluate a company, how do you balance that core operational performance with the full picture of economic costs? It's something to think about.
Absolutely. Okay, let's move on to slide 3, the engine room business segment performance. So when we talk about BioCryst engine right now, it really comes down to one main driver, doesn't it?
Yeah, it's ORLADEYO. Their oral, once-a-day treatment for HAE attacks. It's clearly the commercial powerhouse. This quarter, $156.8 million in net revenues. That's up a really strong 45% compared to last year. Just incredible momentum. They are executing extremely well with their lead product.
And like you said, it's not just a fluke. That 45% growth is built on some really solid foundations. Management pointed out a few things. One, record patient demand. They had the highest number ever of new patients starting the drug in the U.S. That's key for future growth. 2, strong patient retention. Fewer people are stopping the drug compared to early last year. That makes the revenue much more durable, more predictable. And 3, better economics. They mentioned gross to net improvement. Basically, after rebates and discounts, BioCryst gets to keep a bigger slice of the pie for each prescription. You put those together, more patients sticking around longer, and better economics per patient. That's a recipe for strong, sustainable growth. And the really cool thing is how ORLADEYO's success is sort of changing the whole company's story, their pipeline, the future drugs. It used to just consume cash. Now ORLADEYO's profits are funding it. Management's been very clear about their path to profitability and this newfound financial independence. It means they can push forward with these new drug candidates without having to go back to the market for more money, which can dilute existing shareholders. That massively de-risks the future, right? It shifts the whole investment case from being just ORLADEYO to being about a multi-product pipeline. That's a big deal.
It is a big deal. And we're already seeing what that pipeline funding enables, with several key milestones coming up soon. Things for you to watch. First, pediatric ORLADEYO. They're seeking approval for kids aged 2 to 11. The FDA's decision date, the PDUFA date, is December 12, 2025. If approved, it'd be the first oral option for these young kids, maybe around 500 patients in the U.S., a significant unmet need. Second, BCRX 77725. This is for Netherton syndrome, a really severe genetic skin disorder with no approved targeted treatments. We should see initial phase 1 data by the end of this year, 2025. And third, avoralstat. This one targets diabetic macular edema, or DME. Huge market potential here, maybe 1.5 million patients in the U.S. It's aimed specifically at the maybe 40% of patients who don't get full relief from current therapies. Again, initial phase 1 data expected by year-end 2025. So 3 distinct shots on goal, all funded internally, all with data coming fairly soon.
Okay, great rundown of the pipeline. Let's shift gears slightly. Moving on to slide 4, financial strength and shareholder rewards. Because it wasn't just about the profit this quarter, right? Management also made some clear moves to strengthen the company's financial foundation. They ended the quarter with a healthy cash balance, $287 million in cash and investments. That provides a nice cushion.
A very solid cushion. But what really caught my eye was their proactive approach to debt. They paid down $75 million of their term loan back in April. And then, importantly, they announced another $50 million prepayment in July after the quarter closed. So if you look at it on a pro forma basis, accounting for that July payment, their main debt facility is down to just under $200 million. $199 million specifically. That's a significant reduction. And paying down debt for a biotech company just hitting profitability, it's actually a really smart way to return value to shareholders at this stage, maybe even more impactful than buybacks right now. Why? Because it directly cuts risk. Less debt means less fixed interest payments choking cash flow. You already see that impact. Their interest expense was down 13% year over year to $21.6 million. That saving drops straight to the bottom line or frees up cash for R&D. But the bigger picture, the longer-term benefit, is building that financial resilience. Lower debt improves their credit profile, lowers their cost of capital overall, and drastically reduces the chance they'll ever need to issue more stock and dilute everyone down the line if things get tough. It's fascinating how, for a company like this, just cleaning up the balance sheet is such a powerful way to protect and enhance long-term shareholder value. It builds a much stronger foundation.
Right, that makes a lot of sense. Okay, let's bring it home with slide 5, the road ahead management's outlook and key takeaways. So looking forward, what's management telling us? Their guidance definitely seems to project confidence. They stuck with their full year 2025 ORLADEYO revenue forecast, $580 million to $600 million. And what's really key about that number is that it already factors in the planned sale of their European business. That means they expect 0 revenue from Europe in Q4, yet they're still confident in hitting that big number. That implies really strong underlying growth assumptions for the U.S. and other remaining markets.
Exactly. And they've laid out a very explicit and I'd say accelerated timeline for hitting sustainable profitability. They call it their path to profitability. The target for this year, 2025, is positive net income and positive cash flow for the full year. And that's excluding the cash used for those big debt prepayments we just talked about. Then, looking out to 2026 and beyond, the goal is, quote, meaningful and sustainable cash generation. That's a clear signal. They're moving definitively beyond just breaking even. So let's boil this all down. If we synthesize everything, the Q2 results, the market's reaction, the debt paydown, the guidance is definitive. What are the key takeaways for you, the listener? First, the profitability inflection point has arrived. This quarter wasn't a maybe, it was definitive. Huge earnings beat, operating margins doubling to over 18%, significant positive operating cash flow, $44.6 million. BioCryst is now a profitable company. Second, ORLADEYO is a durable commercial powerhouse. That 45% growth isn't just a number, it's backed by fundamentals, record new patients, lower drop-off rates. This makes their $1 billion peak sales target seem much more credible. Third, proactive de-risking creates shareholder value. Using cash flow to aggressively pay down debt is smart capital allocation. It strengthens the balance sheet, cuts risk, and protects long-term value. Very disciplined. And finally, the next growth chapter is fully funded. ORLADEYO's success means they don't need outside cash to advance the pipeline. Those upcoming catalysts in pediatrics, Netherton syndrome, DME, they're funded. The company controls its own destiny now.
Okay, so putting it all together, the final narrative here really feels like Q2 2025 was that pivotal moment for BioCryst. It's when their strategy just clicked into place, kicking off this really powerful positive feedback loop. Think about it. Strong sales of ORLADEYO drive profits. Those profits generate cash. That cash pays down debt, de-risking the company. And that stronger financial position then funds the next wave of innovation from the pipeline. So what does this mean for you? It signals a clear shift. BioCryst has entered a new phase 1 that looks more sustainable, less risky, and focused on steady value creation. It's a real inflection point. And that wraps up our deep dive into BioCryst Pharmaceuticals Q2 2025 earnings. Hopefully walking through it this way, using our framework, helped cut through the noise and really understand what happened and what it means.
Absolutely. And, it's a good reminder, applying this kind of structured thinking, asking critical questions, you can do that with any complex information, not just earnings reports. It really helps unlock those aha moments.
Definitely. Now, before we sign off, the necessary formalities. This report is for informational purposes only. It does not constitute financial, investment, legal, or tax advice. All investment decisions should always be based on your own research and in consultation with a qualified financial professional. Also, this report was generated by an artificial intelligence model, integrating data from the company's official earnings press release with publicly available market data. All information, including financial data and calculations, should be independently verified by you before making any decisions. Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.